If you have a student loan, you may need to take action by July 1st because there are some significant changes coming your way.
After months of confusion and ongoing debate around student loans, the Department of Education has officially finalized a major new rule that could significantly change how Americans borrow and repay student debt. According to the announcement, the goal of these changes is to lower college costs, simplify the repayment system, and reduce what the government describes as excessive borrowing. One of the biggest updates is the introduction of a new repayment structure called the Repayment Assistance Plan, or RAP. This plan is designed to streamline the current system by reducing the number of repayment options and tying monthly payments more directly to a borrower's income. Officials say this new structure will help prevent loan balances from growing over time due to unpaid interest, which has been a major issue for many borrowers under existing plans. At the same time, the rule also introduces stricter limits on how much students and families can borrow. This includes potential reductions in graduate student loan limits, as well as changes to Parent Plus loans, which many families rely on to help cover college costs. The Department of Education says these changes are necessary to protect both borrowers and taxpayers from taking on unsustainable levels of debt. But not everyone agrees. Some critics argue that while the system may become simpler, certain borrowers could end up paying more each month depending on how the new repayment structure is implemented. Others are concerned that limiting federal loan options could push more students toward private loans, which often come with fewer protections. One of the most notable claims in the announcement is that these changes could save taxpayers more than $409 billion over time. And that raises a key question: where exactly are those savings coming from? Because as these changes begin to take shape, many borrowers are starting to wonder how their own monthly payments could be affected. And as soon as this news hit the internet, reactions started pouring in.
Major changes to student loan repayment for married couples. The Department of Education dropped this little nugget in the court filing that they filed this week in their lawsuit that they're being sued by the American Federation of Teachers. And so the little nugget that has a lot of us concerned is the Education Department expects that by May 10th, loan servicers will implement the treatment of spousal information for ICR, pay-as-you-earn, IBR, such that borrowers filing separate income tax returns or are separated from their spouses will have the spousal income counted for the purposes of calculating the monthly payment. And this was a shock to a lot of us because this has not been a thing before. There used to be a loophole where if you filed your taxes married filing separately, only the spouse's income that took the loans would count for their monthly payment. However, as of May 10th, they are going to count both spouses' income.
This change is important because it would affect one of the few planning options married borrowers have had under income-driven repayment. Historically, many married borrowers could choose to file taxes separately so that their student loan payment would be calculated using only their own income, rather than their combined household income. That did not always mean filing separately was the best choice, because it could lead to a higher tax bill or the loss of certain tax benefits. But it gave borrowers a choice. If spousal income is now counted even when a couple files separately, that choice becomes much less useful. The concern is that a borrower's monthly payment could increase based on income earned by a spouse who may not have taken out the loan, may have their own financial obligations, and may not have been part of the original borrowing decision. That creates a real policy question: should student loan repayment be based on the individual borrower's ability to pay, or the household's combined ability to pay? There are arguments on both sides. Supporters may say that household income gives a more accurate picture of financial resources. But for borrowers, this could feel like a major shift, especially for couples who made tax and repayment decisions based on the old rules. It also makes planning more complicated. Married borrowers would need to look at their repayment plan, tax filing status, spouse's income, household size, and long-term forgiveness goals together instead of treating them as separate decisions. So the takeaway is not just that payments could change. It is that the strategy married borrowers use to manage those payments may be changing too.
Paying student loans sucks. And if you're not willing to listen to me, I don't give a fuck. You can keep going. But if you are 18, 19, whatever, you're deciding that if you should go into student loan debt or not. Hi, my name is Katie, and I took out $220,000 student loans for my undergraduate degree, and I'm paying that shit off constantly. Every single dollar that I make in my medical device sales career goes to my student loans. In the last 10 months, it took me 9 months, I paid off $50,000 of federal student loans. So I only have private student loans left. And let me tell you, I know that this bill was passed and now, the amount that you can take out federally is reduced, and a lot of people are going to have to take out private student loans. I am urging you to try and find as many creative solutions as possible not to take out the private student loans or to reduce the amount drastically, because I'm telling you, as somebody with $170,000 of private student loans, they are a nightmare. My minimum monthly payment is $1,100 a month. They compound interest daily. And the interest started accruing the day I took them out. So when I was a freshman in undergrad, not the day I graduated. So it has just been compounding. I actually took out $120,000. I graduated with $170,000. $50,000 of interest in those 4 years. They're a trap. Don't do them if you don't have to.
This is an important distinction because private student loans are a completely different conversation from federal student loans. A lot of the headlines right now are about federal repayment plans, income-driven repayment, forgiveness programs, and government rule changes. But private student loan borrowers usually do not get those same protections. With private loans, your options often depend on the lender, the loan contract, your credit profile, and whether you have a cosigner. There usually is not a federal income-driven repayment plan, and there typically is not broad forgiveness if your income drops or your financial situation changes. That is why private student loans can become especially stressful. If the payment is too high, the borrower may have fewer built-in safety nets. They may need to look into refinancing, requesting hardship options, negotiating with the lender, or adjusting their broader budget. And for people with cosigners, the pressure can be even greater because missed payments can affect someone else's credit too. So when people talk about student loan relief, it is important to separate federal loans from private loans. Federal borrowers may have changing rules, but private borrowers are often dealing with a more rigid system where the lender has much more control. That is why anyone with private student loans needs to read the fine print, understand their interest rate, know whether the rate is fixed or variable, and be realistic about what options they actually have before payments become unmanageable.
How much is your student loan payment going to be when your payments resume on a new repayment plan if you're leaving the Save Forbearance or simply looking to change repayment plans? It's probably the most common question we have been seeing over the last couple weeks, so I wanted to share some examples. But first off, I wanted to give you a couple reminders. First, there are still pathways to get a $0 student loan payment if you don't make a lot of money and you have multiple kids. Your pathway for that's going to be IBR, or income-based repayment. RAP is still very low, but it does have a $10 minimum payment. Part 2, as you're looking at these payment amounts, please use your adjusted gross income from your tax return, not your total income. Your adjusted gross income will always be lower than your total income, even if you're taking the standard deduction, and that saves you money when it comes to your student loan payment. And number 3, realize that all of your income-driven repayment plan payments will only show your payment for 12 months, and then they jump up to the standard plan payment amount. Scares a lot of people. But remember, you avoid that jump in 12 months by simply recertifying your income and getting another 12 months. So I want to start here and show you a couple payment scenarios so that you can get a good sense of what student loan payments will look like. First, we're going to look here at somebody that is making $45,000 a year as a single person, and you can see that down here at the bottom, if they're going to enroll in the RAP plan, $45,000 a year is going to give you a $150 a month RAP payment. It's going to give you a $187 a month IBR payment for new borrowers and $280 for old borrowers. RAP typically always beats old IBR, and new IBR typically wins once you get up to higher dollars amounts. Next, let's look here at someone that is making $65,000 a year with that same $60,000 loan balance. You can see here that RAP is $325 a month. New IBR is $353 a month. They're still very close, but RAP wins. Remember, our general rule is that RAP will typically win if you make less than about $90,000 or $100,000 a year, which is where we're going next. At $90,000 here, you can see the inflection point because this person is single. If you start throwing some kids on there, it gets a little mixed. But at $90,000 a year, your RAP payment is going to be $600 a month. Your new IBR payment will be $562 a month. So new IBR wins. Now, I want to show you how do you get to $1,000 a month payment. You've seen the comments and the stories. I have $1,000 a month payment. It takes a lot of income to get there. So to clear $1,000 for IBR and RAP, it's $142,000 a year in adjusted gross income, which gets you a $995 IBR payment or an $1,100 RAP payment. So it is possible, but if you see those numbers, it's someone that has a lot of income. If this is helpful, please save this and send this to a friend that needs to know it.
This is a good reminder that student loan payments are not just based on how much you owe. They can also depend on your income, family size, tax situation, and which repayment plan you choose. That is why two borrowers with the same loan balance can have completely different monthly payments. But the lowest payment is not always the best long-term option. It may help your budget now, but it could also mean paying for longer or relying more on forgiveness later. So before choosing a plan, you should compare the monthly payment, total repayment timeline, interest impact, and forgiveness options.
Because of the big beautiful bill, the Department of Education is making changes to how student loans can be accessed and repaid. As of July 1st, if you are on a loan repayment plan, there's going to be two options, the standard plan or the repayment assistance plan. Also, Grad Plus loans will be eliminated for new borrowers. Then there'll also be lifetime loan caps. So if you're going for a graduate degree, your cap is $20,500. Or if you're going for a professional degree, your cap is $50,000. Whereas the lifetime cap for a graduate degree is $100,000 and the lifetime cap for a professional degree is $200,000. And even if your parents wanted to help you pay for college, they now have lifetime borrowing caps for you because they can borrow up to $20,000 per year or a maximum of $65,000 per child total. There's also going to be changes for Pell Grants. So if you get enough scholarships to cover the cost of college, then you won't be eligible for Pell Grants. But there are things that you can do now to help prepare for those changes. The first is if you are on the SAVE plan, you need to move your loan out of it because that plan is about to be eliminated. One of the existing plans, the pay plan, will remain until 2028. So if you're eligible, you might be able to switch your loan to that plan. And remember, there are only going to be two repayment options available. That's going to be the standard plan and the repayment assistance plan. There are pros and cons to each option. But if you do find yourself in the repayment assistance plan, just know that your repayment is going to be in line or in step with your income. However, there are no caps on monthly payments. So if you make a lot of money, you could end up owing a lot of money each month, thus costing you the flexibility about how you want to use your budget. And also, a minimum monthly payment is always required. So if you are low income or have no income, that could be a problem. And lastly, if you follow the program all the way through, it could take about 30 years to repay all of the debt. So with all that said, will you be impacted by this change? And do you think that these changes are more harmful than helpful? Let me know what you think, and if you like these sorts of discussions, like and follow for more.
This part matters because lifetime borrowing limits may reduce how much debt students can take on, but they do not automatically reduce the cost of college. If federal loans no longer cover the full cost, some students may have to rely on private loans, family help, or a cosigner. And for students who do not have those options, the result could be simple: they may not enroll at all. So the real issue is access. Borrowing limits may protect some people from taking on too much debt, but they could also make college harder to reach for students without financial backup. Before you make any decisions, check out the resources linked in the description, including the official U.S. Department of Education press release, so you can read the details for yourself and see how these changes may affect your own student loan situation. Comment below with your current student loan concern, hit like if this breakdown helped, and subscribe so you don't miss the next update.